Hey everyone, Upstart, the AI lending company, reported quarterly earnings results that sent the stock price absolutely crashing. Here I have a chart of what happened to Upstart's stock price following the announcement of the earnings, and you can see that big gap lower from close to $30 per share before earnings results and then gapping down closer to $21 per share after the earnings were announced. So in this video, I'm going to review Upstart's latest earnings results. I'm going to highlight the reasons why the stock price crashed. I'm also going to answer if I think this crash is a buying opportunity or if the crash was justified and if investors should avoid this AI lending stock. So let's get right into the earnings.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
Starting with total revenue, which came in at 135 million, that was down 14% from the third quarter of 2022. Lending partners originated 114,464 loans, totaling $1.2 billion across the platform in the third quarter. That was down 34% from the same quarter the prior year. So more and more so, lenders are pulling back from Upstart's platform. That's been the big story ever since interest rates started going up, really at the start of 2022. Lenders started pulling back from the platform in a big way, and that really disrupts Upstart's business model. Remember, Upstart's ideally would like to just be a platform that brings together borrowers and lenders and encourages transactions to take place between the people that come to its website and the people that want to lend on its website. Upstart wants to provide the model, the AI model, that approves or disapproves people filling out loan applications. So it wants to provide the technology, it wants to provide the AI behind all of the action that happens on its website, but it doesn't want to participate in making the loans. It doesn't want to act as a bank. It doesn't want to act as a lender. Ideally, it doesn't want to do that. However, since the lenders on its platform have been significantly pulling back and saying we don't want to make loans, Upstart has had to step in and say, okay, fine, we'll provide some money, some funding for these loans. Otherwise, the borrowers that come to the platform are going to find there isn't enough lending available to fill their needs. And so that's what it's been doing lately. And the more and more it does that, the riskier and riskier and riskier the company becomes, because those are loans that now the company owns. And if there are defaults, Upstart is exposed to those defaults. But it's felt like it's had to step in and do this because there's been such a large gap of funding on its platform. So moving on, the income or the loss from operations, the company lost 43.8 million on the bottom line. This was better than the 58 million it lost in the same quarter the prior year. Upstart has done well adapting to the changing conditions, reducing hiring, reducing spending, trying to control for the fact that the company has turned around really quickly. In 2021 and 2020, this was a fast growing company, and it just almost suddenly did a U-turn, and now it's declining. It's in decline stage for the moment because of those trends that I mentioned earlier. And for the next quarter, management is forecasting more pain ahead. Revenue expected to come in around 135 million and a net loss again of 48 million, similar to what the company lost in the previous quarter. So no improvements on the horizon for Upstart anytime soon. So let's get a look into Upstart's balance sheet, and we really start to see the impacts of the decisions Upstart has made to step in and fund some of these loans. So this is December on the left-hand side of 2022. Here we have September 30th, 2023 as of that date. You can see the loans held at fair value going from 1 billion down to 972 million. That could be for two reasons. Number one, it could have funded fewer loans, which it did not do. I think it funded more loans on the balance sheet. Number two, it could be the value of these loans have decreased as interest rates have increased. Remember, the major overarching theme when you're dealing with loans, bonds, mortgage-backed securities, any lending asset is that when interest rates go up, the value of these assets goes down because investors are willing to pay less now that interest rates are higher because they can get the same amount of return with a relatively safe government bond. And so why would they want to buy these loans that are riskier than a government bond? And so the values must come down to entice investors to purchase these loans, and so the fair value decreases. Also, Upstart has had to increase its own borrowing. It now has $1 billion in debt. As you could see here, that's where it got the money to start making the loans because Upstart is not a bank, so it doesn't have customers making deposits that it can then use those deposits to make loans to fund loans. Rather, Upstart, in order to fund loans, has to use either its own profits or it has to borrow money in order to have cash to fund these loans. And more so, it's borrowing money to fund these loans rather than using its profits because it hasn't generated sufficient profits to make loans of this magnitude. Looking at Upstart's cash flow from operations tells a further story about what's been happening with Upstart's use of cash, its lending, and so on. So the two items I want to highlight here is the purchase of loans held for sale and the proceeds of loans held for sale. So this is the difference between the money that Upstart uses to fund loans and the money that Upstart gets for selling these loans. Sometimes Upstart initially funds the loan, holds it for maybe a week or a month or a quarter, and then it sells it off to investors. And so what you'll notice here in the 9 months ended September 30th of 2022, Upstart purchased nearly $7 billion in loans held for sale, and the proceeds came in at $6.374 billion. So the difference of those two was a negative nearly 700 million, meaning Upstart used 700 million of its own dollars because of this difference between purchase and sales. That's the difference that Upstart had to contribute. This year, however, Upstart has narrowed that difference. You can see in the 9 months ended September 30th, 2023, the purchase of loans held for sale came in at around 2.1 billion and the proceeds came in at around 1.9 billion. So about a 200 million difference of funding that Upstart had to use to fund these loans on the platform or to help encourage lending and borrowing on its platform directly, indirectly. However, Upstart had to finesse and engineer the activities in order to get these loans funded so that customers can continue coming to the website and loans can continue being made and the business can move forward. So I highlighted earlier that Upstart has been using more of its money to fund these loans, and you can see that apparent in the loans held on its balance sheet at fair value. As of the third quarter of 2023, you could see the total value of loans on the balance sheet at 972 million. That was up from 838 million in the previous quarter and 700 million in the same quarter the prior year. Also, personal loans are making up a bigger proportion of overall loans at 329 million of the 972 million compared to 249 million in the same quarter the prior year. These loans here, the company has $447 million of the $972 million of loans on the platform. It's holding on to these for testing and evaluation purposes. Because it's a new business model, right, using artificial intelligence to make lending decisions, this business model is not proven yet. This is partly the reason why I mentioned earlier that lenders are pulling away from the platform, saying we don't want to fund loans on the platform because lenders looking across the macroeconomic spectrum and observing the Federal Reserve rapidly raising interest rates, fears of an economic recession are rising, and when there's a recession, that's when it's more likely that people will default on the loans. And so this is when lenders do not want to be making loans right when the fears of defaults are increasing, right? But with traditional loans, you had bigger history, longer history, decades, hundreds of years of history using their traditional lending models to see what the default rates would be for different categories of loans. With Upstart using AI to make these lending decisions, you don't really know yet what these default rates are going to be like. You don't really know yet. You can estimate, you can use mathematical models and projections and assumptions, but lenders don't really know yet. They don't have the hard data. This company has not been through not even one economic downturn to observe what the default rates are going to be like during a recession, let alone several recessions, so that you get more robust data in terms of the default rates. And so you can understand why lenders are pulling back and saying, hey, we don't want to be making loans right now on your platform. So I highlighted earlier the increasing percentage of personal loans. You could see again here the lending by product in the third quarter of 2023. The number of loans increased, the personal loans 113,252, up from the second quarter by 6%. But if you just look at the number of auto loans, that was down 52% from the previous quarter. Why is that bad? Well, think about it this way. If you're a consumer and you're experiencing difficulty with your finances, which one are you going to default on first? In other words, which loan will you stop paying first? Your personal loan, which if you stop paying, there is no collateral, there isn't going to be anything taken away from you, or your car loan, where if you stop paying your car loan, they're going to come and repossess your car. Of course, you're going to pay your car loan first instead of your personal loan. So with Upstart experiencing a significant decrease in auto loans, which are more secure, and experiencing an increase in personal loans, the riskiness of the business is only taking another step higher. Now, Upstart's not the only one that's experiencing this trend. I did a video on SoFi Bank a few days ago, and it too is experiencing a similar trend in that most of its loan growth or loan transactions are coming from personal loans with no collateral and a higher default rate. And so these companies feel like they must fund these loans, and these are the ones that they're going after because that's the choice that they have. They don't have any other choices because there hasn't been demand for other categories that they can serve. And so they've got to choose this because that's what's available to them. Not looking good, because these are bigger risks just when the economy is slowing down and showing signs of pressure. This isn't where you want to be as an investor, exposed in the area that's going to be hit hardest when there is an economic downturn. So to answer the question, is this a buying opportunity for Upstart stock investors, or should they stay away? Well, looking at its valuation, Upstart is trading at a forward price to sales of 2.65. While it's down considerably off its high, it's a different business than it was during this peak valuation point here. A lot of times you'll hear me say that the company should have never been worth this much at this point in time because there was a euphoria in the market in 2021. That's not the case for Upstart. I think Upstart's peak valuation here was kind of justified because the business was doing so well. It was making significant progress towards profitability on the bottom line. It was even profitable for a couple of quarters. Revenue was growing rapidly. There was a lot of enthusiasm for participating on the platform from lenders. And so I can understand the peak valuation here. But I can also understand that the valuation here is still not where you want to come in. And so I would say, no, this is not a buying opportunity. Before I would invest in this stock, I would wait to see this business model using AI to fund loans. I would wait to see it perform at least through one recession, one economic downturn, to see what the default rates are, how lenders respond to those default rates, and what the business equilibrium is. At what level of revenue will the business settle at once it goes through that economic downturn, once it shows real evidence of default rates during a downturn. So for those reasons, I would stay away from Upstart stock right now. So I would keep this stock at where I had it before the earnings were out. Remember, I did not have this stock rated as a buy. I had it closer to a hold or a sell, and I'm keeping it down there as a hold or a sell. But before I let you go, if you gained value from this video, please subscribe to the channel. It really helps support more videos like this one. Thank you for watching.